might not go into detail of accounting. However, if with time any of you have the interest to become an accountant, you still have the right and the liberty to go deep into it. And so our main aim now is to help you so that you can know what to expect. And so that even though you are an HR person, nobody will bully you with technologies or any other thing. And so our objective this evening is to understand what financial statement is, what the composition of financial statement is, and how you can organize your information on a financial statement. Also for you to identify the users of accounting information, the type of businesses, and the type of information they require is also necessary for you to. So from the slide I sent you, you will notice that we have two main categories of users of accounting information, the internal users and then the external users. The internal users comprise with the owners of the entity, then the employees, and we also have managers who would want to have accounting information in order to know how the business is performing. External users have to do with investors and the government agencies. They would want to know whether you are paying your taxes, and then whether your business is doing well so that they'll be able to invest in your business. Now, basically, the financial statement has to do with basically 4 or 5 components. We have the statement of financial performance, which could be called profit and loss account. And this statement shows the amount of revenue generated within a specific period, and then expenditures that were made in acquiring that revenue. I'm sure when I say revenue, you understand what revenue is. Revenue is income generated from a trade or business. Then expenditure are the expenses that you made in acquiring or in getting your revenue. So the statement of financial performance looks at those ones. Then after preparing the statement of financial performance, we look at the statement of financial position, which most people call balance sheet. And this statement has to do with your resources that you are using in operating your business, which we call assets, and then your liabilities, which are the whether loans or the debts or trade credits that you are using in your business. And then there's something we call capital, is the amount that you use in starting the business. So the statement of financial position look at those 3 things to you. And then you have statement of cash flow. And that one just tells you how cash was generated into the business within the financial year and how it has been spent. So we call it inflow, which is the revenue you brought in or the cash that comes in. Then the outflow are the expenses that you have made. Then all this information is to be given to somebody to profit somebody. And those people who uses those financial information are the very one we refer to as the users of financial information. And so after you have presented these statements, there should be a note or writings to explain the content of the financial statement. And so at your level, we are looking basically from the beginning of events to the end user, which comprises the preparation of financial statement. At your level or for this semester, that is what we will be looking at. And so when you read through the slides, you will see basically what I just said. You will see the details more in there. And the next time that we meet, those of you who do not understand, of course, I know your background is not in accounting, so these are basic things. And if there's something somebody didn't understand, the person can jot it down. And each time we meet, you ask those questions first, then we proceed. So when you look at the accounting equation, which explains what is in the statement of financial position or the balance sheet, we said assets equals liability plus owner's equity. And I've explained this one as assets is the total resource that you are using in the business. The liabilities are the owings that you have in your business, and then the owner's equity or share capital or capital is the same name. They are the money you have invested yourself. And so when you look at those things, I think there are brief notes on them. So at any point in time, the assets of the business should be equal to the liability and then the equity or capital invested into the business. Let me explain this side small so that you can understand. There are examples in the slide I've shared. So we said the asset is the total of everything you are invested into the business or the business is owned. And that should be equal to whatever the business is owing somebody and whatever the owner has put into the business. So whatever the business is owing somebody is the liability. And whatever the owner has put into the business, the owner or the owners have put into the business is the owner's equity or the capital. Now, the capital structure would depend on the type of ownership of business, whether it's a sole proprietorship business, partnership, or a corporate limited liability company. This one, when we say sole proprietor, we are talking about a company for an individual, an entity, a business organization that is set up by one person, managed by one person, and then one person gain profit or loss. Then when we talk about partnership, it's a group of people coming together to form it, not less than 2 people and not more than 50 people. And then when we talk about company limited by shares, we are also talking about a group of people which has unlimited numbers. And they float their shares or they invite people from various backgrounds or the public to invest in their business under the company's code. They can be many as, for instance, MTN, for instance, the company limited. So they have float their shares. Commercial bank, the same thing, they float their shares. Anybody that want to be owner of it can go and buy it. And it's not limited. So the profit is not meant for one person or just a small group of people. It's shared according to the amount of money invested into the business. So we are saying that at any point in time, whatever your business is having should be equal to what the business owns. That is the liability plus what the owners have invested into the business. And that is the accounting equation, which we say assets equals liability plus capital. And you can turn this thing anyhow. Easy. If you want to find liability, liability will be equal to asset minus equity. If you want to find equity, is asset minus liability. So at each point in time, you can find any of these things. Since this is the component of a balance sheet or statement of financial position, it is easy for you to know if they have given you two of the components, you can find the other one. I hope you understand. And so we will take some few examples, and your syllabus have required that we take you through how to record financial transactions. So we'll be taking you to the books of primary entries. When you sell or you buy, what should you do? We will introduce you to that in our next lesson. So for this unit, we want you to see the understanding of a general view of accounting. What is done, what is expected, so that when you are reading or you are looking at accounting information, you as an HR person will be able to understand it and give some interpretation or meaning to it. Then after an account is prepared, because it is prepared by the management, there's the need for a group of people to investigate the figures or the things they are reporting to the owners. And so those people come to authenticate whatever management has presented in the form of account to the owners of the business. And those people are called auditors. So we say auditors are just there to make sure that what management has presented as a report at the end of the year to the owners of the entity is credible, reliable, and true and fair. And that is the work of an auditor. That is what they do. This thing in all is done with principles. And that is what we call accounting principle. So you don't just get up and report it anyhow. There's a principle to follow. And that principle is known as accounting principle. There are regulations that govern the preparation of financial statements. And those ones too, we call them accounting standards. Accounting standards. Those standards guide people. And so if Abraham is preparing his account, Beatrice should be able to understand what he has done. And Peter should also know that this is showing here and this is showing there as same understanding that Abraham will have. Beatrice should also have the same understanding. Peter should also have the same understanding. Another person should also have that understanding. In order to achieve that, there are standards for the individuals to meet in preparing the financial statement. In Ghana, the standards are being controlled by the Institute of Chartered Accountants, ICA, in Ghana. They control the body that was set up by government, by the Act of Parliament, to control how financial statements are to be prepared. Also, the company's code also guide the preparation of accounts. The Securities and Exchange Commission also guide the preparation of accounts. And now we even have various regulations. If it is public sector, we have public sector accounting standards that will guide them. If it is private sector, we have financial reporting standards that guide them. So that at any point in time, anybody in Ghana or outside Ghana, when it takes your account, it's conformed with a specific standard. Whilst doing this, there are ethical behaviors or ethical standards too that should be adhered to, such that you don't lie, you don't just put any figure in the books. So we call those things the professional ethics. Professional ethics. You don't just tell the accountant that, oh, put this figure there, increase the sale by this so that we get this profit. No, there's an ethical standard that are governed. And anytime any of these bodies realize that you have breached this ethical standard, they come with sanctions against you so that they can sanitize the entire system of financial management. Without much, I think we will end it here today. If you have any question, you can ask. Thank you. Hello?
Yes, sir.
Yeah. And so I think your people can then unmute themselves.
Sir, please, we can hear from you, sir.
So I want to give space for questions. We just had an introduction to the principle of financial accounting, principles of accounting. If you have any question. Is someone having any question? Hello?
Yes, sir. Sir, please, we can hear from you.
Yes, I'm asking if somebody have any question.
No, sir. I have no questions, sir.
Okay.
So I think we are all following, so we are on the same thing.
Mr. Musa?
Oh, we say hello, sir.
Yes.
Oh, sir, please, I learned that there's a company which is a non-profitable company.
Yes.
Okay. And with that one, why is that the auditors still go there? Why is it that they go audit that people? Because it's a non-profitable company.
Okay. When we say a non-profit, it's not non-profitable, it's a non-profit making organization.
Okay, sir.
Their main objective is not to make profit, but to achieve a specific target. Maybe social intervention. And so they receive income, but their main objective is not to make profit. And so as much as you receive money and spend money, you should account for it. And that is why auditors still go to them. And don't forget that once we call it, because we call it non-profit making organization, doesn't mean they will not make profit. They can make profit, but what we are saying is their main objective is not to make profit. For instance, let's say Ghana Health Service. Ghana Health Service, their main objective is to take care of the health needs of Ghanaians. It was not meant to make profit, but that doesn't mean that they will not make profit. Please, do you understand?
Yes, sir.
So when you read type of businesses, you will see that two categories: profit-making organization and non-profit making organizations.
Okay.
Sir, please, my question is based on what he asked. So does it mean in as much as they are making profits, are the auditors auditing them to see if they are paying taxes or the money are being allocated to the right places? Is that the reason? All right.
I think that is exactly what the auditors do. Don't forget that auditors, they are not thief catchers. They are not meant to go and catch thieves. Auditors are only going there to make sure that internal controls are adhered to. In other words, they are just to make sure that what you said you were going to do, or what they have given you money for you to do, you have done it that way. Or what you said you have bought, you bought it at the price at which you said you have bought it. They are there to make sure what you said you have done, or what they say you should do, you have done it well. It is only when there is an allegation that somebody has done something unusual that we have a forensic audit. So when a forensic audit is meant specifically to go and identify an allegation that somebody has made against something. Apart from that, audit in itself is only meant to provide assurance that what the organization is supposed to do, it has done it.
All right, sir. Thank you, sir.
Yeah. Okay. So, Stephen,
Yeah.
Stephen, are you there? Any question?
Say please, I'm here.
Okay. So, I hope there is no match again.
Yeah, please. But I think I'll prepare myself for that. Then the next time we meet, we see how we go with it.
Okay.
Okay, sir.
All right. Okay. Thank you very much. Today we didn't introduce ourselves because I think the network wasn't good in the morning.
Sure.
And probably the next time we meet, we may introduce ourselves and then probably look at the faces of one another. I wish
All
you
right,
well.
please. Thank you, Rob.
Thank you very much. But
Have a
I
nice-
didn't speak to them. Have a nice day, my people.
All right.
Yeah.